Welcome to The Explainer. Today, we are booting up, kind of like a high-tech financial dashboard, to decode the algorithms of wealth. We're diving straight into the basic tools of finance. We'll be looking at how time and, well, risk fundamentally shape the value of literally everything you own.
So let's kick things off with a quick question. Would you rather have $100 today or $100 in 10 years? I mean, it seems like a total no-brainer, right? You take the cash right now. But the underlying math here, it actually drives our entire financial system. Because if you take the money today, you can just pop it in a bank, earn some interest, and end up with significantly more than $100 in 10 years. This introduces us to our very first rule of the road. Money today is simply worth more than that exact same amount of money in the future.
To really get a grip on how the financial world works, we're going to look at three foundational building blocks. 1, the time value of money. 2, managing risk. And 3, asset valuation. All right, let's jump in.
Starting with part 1, the time value of money. As you'll see, money actually behaves very differently as we move forward and backward through time.
Okay, so because money can earn interest, we need a reliable way to translate its value across time. Think of it like a time machine. If you want to know what your current savings will be worth down the road, which we call its future value, you use a process called compounding. Basically, you multiply your current money by 1 plus the interest rate raised to the number of years. Now, on the flip side, if you want to know the present value of some future payout, you just run that equation in reverse. This is called discounting. Let's say you know for sure you want exactly $200 in 10 years for a specific purchase. How much do you need to deposit today at a 5% interest rate? Well, you just divide by that factor, and boom, you get roughly $123. You deposit that $123 right now, and time literally does all the heavy lifting for you.
Now, what's really interesting about this is a handy little trick in finance known as the rule of 70. You literally just take the number 70, divide it by your interest rate, and that tells you roughly how many years it's going to take for your money to double. So if you're earning a 7% return, your money doubles every 10 years. This compounding effect is just so powerful over long stretches of time. To put into perspective, when Benjamin Franklin left $5,000 to Boston and Philadelphia back in 1790, compounding grew that chunk of change into millions of dollars over the next 200 years. Honestly, it's no wonder Albert Einstein reportedly called compounding the greatest mathematical discovery of all time.
Moving right along to part 2, managing risk. This is where we take our nice, clean mathematical timeline and, well, we introduce the messy, completely uncertain reality of the real world.
Let's face it, life is full of gambles. When you go skiing, you risk a broken leg. You drive to work, you risk a fender bender, and when you invest in the stock market, you are absolutely risking your hard-earned savings. Because of a fundamental concept called diminishing marginal utility, economists recognize that most people are what's known as risk-averse. Now, to be clear, this doesn't mean you just avoid risk at all costs. I mean, if you did that, you'd never leave your house. Instead, risk aversion simply means you are rationally pricing that uncertainty into your everyday decisions.
So how do we handle all this? Well, one of the primary ways we deal with risk is just by buying insurance. You pay a fee, and an insurance company agrees to take on the risk for you. But as we all know, insurance markets are far from perfect. In fact, they're plagued by 2 very specific problems. First up is moral hazard. This is basically the temptation to, say, drive just a little bit faster simply because you know your car's bumper is fully covered. The second issue is adverse selection. This means the people who are most eager to buy fire insurance are, naturally, the ones living right next door to a fireworks factory. Because of these twin problems, insurance can absolutely help spread risk around, but it can never perfectly eliminate it.
And this brilliantly illustrates the need for diversification. Think about it. If you put your entire life savings into just one single company, you are incredibly vulnerable. But if you spread that money across 5 or even 500 companies, you effectively eliminate what we call firm-specific risk. One bad CEO making a terrible decision isn't going to ruin your retirement. But, and this is a big but, you have to remember that diversification cannot eliminate market risk. That's the looming threat that the entire economy just tanks and sinks all boats at the exact same time.
So there's a fundamental economic rule at play here. People face trade-offs. We just established that holding stocks inherently involves risk, even if you have a perfectly diversified portfolio. So why on earth do people buy them instead of just hoarding super safe government bonds? Well, it all comes down to the trade-off between risk and return. Since we know people are naturally risk-averse, they have to be compensated with higher potential returns to willingly endure the sheer anxiety of holding stocks. And historically, stocks have indeed offered much higher average returns than safer bonds. It's essentially the market's way of rewarding investors for stomaching all that uncertainty.
All right, let's shift gears to part 3, asset valuation. This is where we combine our building blocks of time and risk to figure out how the entire stock market is actually priced.
Imagine you're trying to pick a winning stock. You'd probably sit down and do what's called fundamental analysis. You'd pore over expected future profitability, you'd look at the stream of dividends, and you'd try to guess the final sale price. Basically, you're hunting for a bargain, right? You're trying to find a stock that's currently priced lower than the actual true value of the underlying business.
But hold on, because a major economic theory suggests that all those hours you spent studying business spreadsheets might actually be completely pointless. Enter the efficient markets hypothesis, or EMH. According to this theory, the stock market exhibits what's called informationally efficient. This essentially means that the current price of any stock already rationally reflects every single piece of publicly available information about that company's future prospects. You've got thousands of analysts out there constantly crunching the numbers, and their buying and selling immediately pushes the stock price to its exact fair value.
Let's move a step further and see how this builds. If the EMH is actually true, and the current price perfectly reflects all public info, then literally the only thing that can change a stock's price is totally new, unpredictable news. And hey, if news is unpredictable, then stock prices themselves must be unpredictable too. Economists refer to this as a random walk. Under this incredibly cold logic, no stock is a predictably better buy than any other, making trying to time the market a total fool's errand. It basically implies that a monkey throwing darts at the financial pages could pick a portfolio just as well as an expert. Crazy, right?
But let's step back and contrast the cold, perfect mathematical logic of the EMH with actual reality. There is a very strong counter-argument out there that stockholders are not in fact perfectly rational calculating machines. Sometimes asset prices deviate wildly from their true value. And why? Because they are driven entirely by human emotion, greed, and the overall psychology of the market.
So, the crucial point is that markets are, at the end of the day, made of people. Back in the 1930s, the famous economist John Maynard Keynes suggested that markets are actually driven by animal spirits, basically these totally irrational waves of optimism and pessimism. Decades later, Alan Greenspan famously asked if a soaring market was just suffering from irrational exuberance. When prices rocket upwards just because everyone is excitedly buying in, completely detached from any fundamental business value, we get what's called a speculative bubble. And bubbles, as we know, eventually pop.
So, we've explored the time value of money, we've looked at the management of risk, and we've weighed these completely conflicting theories of valuation. Knowing all this, do you genuinely believe you can beat the market? Are stock prices perfectly efficient, or are they just swept up in wild waves of irrational emotion, just waiting to be exploited? It's exactly this kind of question that keeps economists awake at night. I hope this explainer leaves you eager to dig even deeper into the mechanics of our financial world. Thanks for tuning in.